everybody. Welcome to another episode of CRESI's Ontario Landlord Podcast. Today, we're going to talk to you, landlords, about a little bit of diversification and another investment strategy or vehicle that's involved with real estate, but just a little bit different than your traditional buy a house, rent it out, or even buy a pre-construction property and wait for it to be built. Again, there's always many different ways and many different experts and professionals to talk about. So how you can best invest your money or what is looking for you. Again, we're always talking about diversification. We don't think you should have all your money in one bucket. You should spread things out in different ways. So today, to go through all this and talk about a different type of investing, as we said, where we can use registered funds instead of just straight cash or extra cash, or he'll get into more of the different options about how you can do that. This is Dan Stuart from Equivest Capital Partners. They are a firm just outside here in Burlington, so local to all of us. They are here to talk to us today and educate you guys, inform you about something that maybe you might not be aware of in a way that we can continue investing in different strategies in real estate. So, Dan, welcome. How you doing today?
I'm doing very well. Thank you so much for asking.
Yeah, awesome. So, let's just be straight and straight to the point here with what we're going to share with these guys today. Why don't you explain what private equity investing is?
Excellent. So you've got basically the investment banking space is something that's not offered from the big five banks. And if you know the right person and are introduced to investment banking, you can have access to incredible opportunities that are equity placements in real estate development. And then there's also opportunities with private lending. And the best part about this is that what we have is our structure is a mutual fund trust. So that means people can just passively participate with their RSP, with their TFSA, and use their registered funds towards something way more fruitful. At the end of the day, everyone should have an excellent diversification within their portfolio. And having hard asset of real estate with a rental property is great. Having some stocks, having some bonds, this is all great. But then having some like 10% worth of your portfolio invested in private equity is a really excellent way to get some more meaningful returns in your portfolio. So, as an example, our development fund is going to be investing in between two and four different real estate developments. And what we do is we focus on some of these secondary and tertiary markets like Brantford, Cambridge, Niagara, where there's a high population growth and there's also a shortage of housing. This might not be necessarily a build to sell strategy. We've got a lot of demand for rent right now, so that means that we can do a rental building, build to rent strategy, and do something like a 100-unit building in one of these markets. And then you fully tenant the building and you can sell it to a pension fund, an institution, or just simply refinance investors out. The returns are very strong with this. Return threshold is about 16 to 20% annually, but what we do is we view it as an equity multiple because when you're coming in to this fund, you're going in as equity partner on day one on the property. We're executing directly with builders and financing. Then we're going through full fruition with the build, project completion, then we can have our exit strategy executed and then everyone gets paid out. So essentially it's about a 5, 6 year type of turnaround is typically what it takes. But because the fund will be investing in 2 to 4 different properties, it gives us the opportunity for diversification within this option of investing as well. So you're not just succumb to the success of one single property, but rather multiple different properties right away. Then the other fund that we have is a little bit different in terms of the way that it operates because it allows you to become a private lender and not have to do any of the heavy lifting of due diligence on who you're lending the money to and how that all works. So we take care of that part for you. And as a result, you can get monthly cash distributions that are quite strong relative to other investments. So this one will fetch anywhere between 8 and 12% as an annual average return on a consistent monthly basis. We have a 3 year holding period for this. And essentially, the way it works is we'll deploy your capital into multiple different opportunities. Sometimes it's a bridge loan, sometimes it's a second mortgage. It depends on what opportunity comes up, but the best part is instead of paying a mortgage, you're actually receiving a mortgage and you're account just naturally grows on a monthly basis. So it's a really great way to passively build wealth on autopilot. Um, so it allows you to be a private lender with your registered funds and not have to do any of the heavy lifting. And so basically, those are the two funds that we're raising capital for the most. And what we're doing is we're just getting out there, we're educating people, showing what's available. And we're going to some of these networking events and meeting like minded investors that like this type of strategy and are interested in learning more.
Nice. So yeah, out there, there's probably you guys aren't the only ones that you can do this with, but I want to thank you for talking about for you guys and the generalities to all this type of investing. If you are looking to get more information from Dan and their group over at Equivest Capital, we can definitely contact with you. So reach out, let us know. We'll get you in contact with them. And as always, contact information will pop across the screen throughout this. So record that and make sure that you reach out to either us or Dan or whatever. We'll get you guys connected if you do have any questions. But to circle back there, I just want people to understand that there are basically generally two different types of funds while you're doing this. One that is projects being built, and the other one is constant money coming in every single month because there is rental income coming in there, whether they are resident units, right? Like you're talking about a big 100 unit building with a whole bunch of tenants, multiple buildings in that fund, or even there's commercial ones and stuff like that where they're getting monthly rents, so they're paying their investors out monthly. Again, just from my train of thought as I'm hearing this, that might be something that's great for someone later in life who just has some savings sitting away that they're able to put into this and just have it spit back out some money every month rather than investing it here or there or wherever they're going to do that to get that return. And then on that development one, that's more of a growth one, right? There's uh, with everything comes risk. That's the whole point of this. What are we are trying to do with all these podcasts is educate and inform so you guys can mitigate your risk and understand what to look for and how to best invest in any type of strategy or vehicle that you want to use. So that development one is again, I guess, more for a growth point, right? Someone that's looking to use some capital to really grow that at a faster rate. The number that you shared, that really is going to double your money in 5 years, right? That's kind of the idea there.
Yes, that's right. So, yeah, the only really there's two big risks with this. One is the time, and then the other one is the illiquidity. So once we take your capital, we're putting it towards the acquisition of these properties. We can't pay out the returns until we exit those properties, but this is what we always describe as the best downside protection that you could possibly get in any sort of investment. Because instead of just investing in some sort of like prospective AI stock, which yes, 1 out of 100 of them will be Tesla, but for the rest of them, they might just straight up fold and you could lose all your money. In this, at least you have the downside protection of the ownership of the property because when we invest in a property, we don't own the property. It's actually the fund that owns the property. And the split is 80-20. So Equivest is the general partner. We own 20% of the properties that we invest in. And then the limited partners, which are the passive investors, they own 80%. And we have a preferred return structure, meaning that once the projects come to fruition and we exit, the first entire 8% is going to our limited partners. Then in private equity, there's something that's called 2% catch up, which is basically the distance between 8 and 10% is 2. That's Equivest profit. Everything beyond 10% is split as 80-20. So we just prioritize the profits for the limited partners and give them the opportunity to passively invest like you're a real estate developer. So instead of owning one tiny little condo unit in a development, you're actually on the other side partnering with the builder and you're part of the profits of hundreds of different units. So it's an amazing opportunity to build wealth.
I definitely agree that this is something that makes a lot of sense for a lot of people that have the ability to do this again. And I'll let you talk quickly because registered funds is a big one that you guys can put in here rather than doing something else with it. RSPs and RESPs are something that we all, I believe, are trying to constantly build. And why not use them for something, right? Other than that first home purchase that you get to take a big advantage of after you've done that and then you've paid that all down. Right now, you're looking to invest that money into your future. This is definitely something that makes a lot of sense here for people.
Yeah.
And again, like Dan said, it's passive, right? That is, I think, the ultimate thing that people try to avoid or want to get with their investment is to just simply have their money make them some money. And as a real estate investor, sometimes it doesn't feel that way. Another one of the reasons why we built the landlord protection program with CRESI Property Management to make sure all of our landlords can have that traditional landlord style investment, buy that brick and mortar, that condo unit, that house, and then we can manage it so it does become as passive as possible for you. But it'll never be as passive as this. At the end of the day, we're still going to have to talk to you if something's going wrong. Where as this is going on, you're basically placing your money and you're either getting a monthly return or you're waiting 5 to 6 years to get that paid back out, and then you can reinvest there. How many projects do you guys have currently on the go? I know of the big one out in Welland, but I'm sure there's some others. Why don't you share what's going on with you guys?
So we've got about 15 million worth of properties that are kind of in the pipeline to be able to be put into our fund. One site is located in Cambridge and the other one is located in Brantford. But we're not just stopping there. We know that over the next 18 months, there is going to be some distressed sale opportunities. We've already seen some. And we know that that's going to provide a huge opportunity because we know we're not at the peak of the real estate market. We're actually in a trough, and that means that getting into this space right now is one of the greatest opportunities because you're not getting into the top when everything's piping hot. You're actually getting into the bottom or close to the bottom, and you're able to maximize your returns and look forward and go, okay, 5, 6 years from now, even if we're not actually in a better market, let's say, the build to rent strategy is still going to be robust. If you take a look at all the market trends, demographics, what's happening with immigration, there is forecasted to be even more demand for rentals, not just in Ontario, but Canada wide. And I think that this is a trend that's going to just continue marching forward. So even if we're not in a more robust real estate market in 5, 6 years from now, that's still going to be something that's going to pay very fruitfully as a result of just engaging now in real estate development with rentals.
Yeah, I agree there. We've talked throughout a couple of different podcasts about the rental market and what's going on there with Ontario and Canada. But one third of our country, more than one third of our country right now pays rent. As you said, that number is going to continue to grow. The rental space stopped being built for so long because there wasn't the incentives there for the builders to do something where they could then turn around and rent it out. So they started doing it more with condominiums and then relying on us, the everyday person, to buy condominiums to rent out to people to help with that rental demand. Well, our lovely government here, we're not going to get too political, but they've definitely made it harder on our everyday landlord, our housing providers to continue to provide that service. And now the government is incentivizing developers and builders to get back into building those rental buildings because there is going to be more, right? As the baby boomers, the biggest uh, generation, starts to downsize to get into different things, they're going to want to liquidate and start renting. And plus, everybody coming up, right? Housing is becoming more expensive and it's going to take longer for people to buy that first home. We won't see as many people in their early 20s buying real estate like what we did over this last decade. But no, I agree with that rental part that it's never going to uh, not be needed, right? Everybody needs a roof over their head. So to be able to keep providing that, I think that helps protect the investment and the money that's in there. That's for sure.
That's exactly right. And what I can do now is just share my screen just to show a little bit of a comparison towards exactly what I'm referring to, because it's important to take a look and go, okay, if we take a peek at a normal investment with just a 5% annual growth, and the only thing with this is that it's actually compounding. We're building that in as compounding. So over a 5 year period, starting with 50 grand, that would grow to about $63,000. With our income fund, that's the bar that's in the middle here, this is a 10% growth. Now, if you're doing dividend reinvestment plan on the income fund, you can very easily achieve a 10% annual average return over as little as a 3 year period. So this gives a huge opportunity to go instead of just from 50 to 63, you're actually going all the way up to 80,000 over a 5 year period. This bar at the bottom here represents the development fund. So this is a non-compounding fund because you're just going in as equity partner, just the same as when you're buying a piece of real estate, and then you're realizing the profits once you exit that project or property. And so what we do is we aim to um, double your capital in a period of about 5 to 6 years in this fund. So that's kind of just a really good way to visually see, okay, if I walk into a bank, I could probably get, well, even 5% is generous these days because GICs are only 3 or 4%, right? And so if you take a look at that, 5% is probably, yes, you can find that in stocks. You might have some crazy volatility along the way. But beyond that, when you're looking at 10 and 20% type of growth, it's a really excellent way to diversify your portfolio and get at some strong returns as a result of that.
Nice. Now, Dan did share his screen there, so if you're watching on YouTube, you'll get to see that. If you're listening on Spotify, Amazon, or wherever all these other channels that we're on now, flip over to the YouTube channel so that you can see that graphic and understand a little bit more about Dan was talking about. But yeah, thanks. That was great to share there. Um, I'm going to let you have a little bit of a plug now. Here's what we're going to say. Why should someone invest with you at Equivest instead of with another firm out there that offers a similar product?
That's actually a great question. So, our team is comprised of 55 years of experience in real estate development, project management, and finance. The CEO of our company, his name is Ali Napur. He has um, transacted on more than 1 billion worth of real estate. He's worked with some of the biggest real estate developers in all of Southern Ontario. As a result of that, he's seen how the other side of this business works. And it's really incredible how you can invest in this space and just in a passive fashion and receive such incredible returns. And he's done this on a syndication base so many different times on multiple different properties and had great success. But how do you grow from that? You grow by building a private equity firm with a mutual fund. And you can have not just hundreds, but thousands of people participate and get involved in these types of returns. So it's an amazing space, but why should you choose our company? We are definitely a smaller team. We have a team of 5 executives here. Now, why is that great? I would argue that the smaller team aspect allows us to be a little bit more dynamic, agile, flexible, make decisions quicker on the fly, adapt to market conditions. We're not going up some big, massive chain of command because it's a huge company. We're able to take a very hands on approach with everything that we do. And if there's some sort of headwind that comes our way, we adapt immediately. And that is something that this team is really good at because every executive member brings something totally different to the table. Our CFO, Paul Mills, he has worked and built more than 10 different investment funds that have encompassed in excess of $300 million. So he has all the expertise with the numbers and the know how. And then my other two business partners have been in this space very successfully, but just without a fund involved for about 13 years now. And so, again, only way to scale and grow is by doing it together as a team instead of just with a handful of guys. So we're really excited to educate people about this space, introduce them to our team, show them how we work, and have investors come on board and join us in this type of journey towards some serious returns.
I think what you just said there rings true to so many different things that we do, and it's about the team that you're working with, who you're surrounding yourself with, and having the support and the knowledge of somebody that's been there, done it before, so that they're guiding, advising, and consulting you to make sure that you're doing whatever is best for you. Um, do you want to finish off with anything at all? One last little tidbit that we can share with anybody? Do you have anything you want to send out, Dan?
Yes, if anyone is interested in learning more, I do actually have basically a 15-minute Zoom presentation that I'm able to walk them through and show them exactly how this space works. And again, this isn't a sales pitch. All it is just education. We give people the opportunity to see what's out there, and it might not be right now that you have the funds or you're ready to go. But if you know that this option's out there, then you'll have it in mind for when you are ready to go. And that's kind of how we built our business. But we have constantly people coming to us saying, "What is exactly you do again? How does this work?" Because it's just not out there. I mean, you can't just put a TV advertisement out there. So please feel free to reach out. We're going to put the links up there. And I'm more than happy to take a phone call, take a Zoom, and just tell people exactly how it works because it's actually quite an easy process. We work with one of the biggest mutual fund trusts in all of Canada, Olympia Trust, and they take care of all of the unit holdings for our exempt market securities. So, instead of buying 100 units worth of, or sorry, 100 shares of Google stock, you're actually buying 100 units of the development fund with Equivest. So it's just that type of investment, right? So I think people should just know that you can take your registered funds to a next level. That even if you don't have a registered fund, you can invest through an entity like a numbered company, or just simply write a check. Some people don't believe in registered funds for one reason or another, but we get all sorts of different walks of life here. So I'm happy to chat and introduce our company and show them exactly what we can do for them.
Excellent. I love it. So the 15-minute information, no selling, just straight information, as Dan said. If you're looking for it, there will be a link and a way for you to get notified about that to set that all up below. So again, CRESI is an acronym for Complete Real Estate Solutions Investments, and we're here always trying to help be your complete solution about anything real estate or investment related. So Dan and Equivest Capital Partners, they're great to talk to, great to work with. There's again other firms that if you don't want to work with these awesome guys, I'm sure you can find someone out there where you would like to be involved with them if you're liking this strategy. So thanks for listening. I hope you learned something today. And if you're not ready for this type of investment now and you are in the future, there's always going to be opportunities. So reach out and we'll connect you with the right people. Thanks so much, as always, for listening, and we'll talk to you soon. Bye for now.
Please remember, while we are professionals, this podcast is for informational and entertainment purposes only. The advice shared may not apply to your unique situation. Always seek personalized advice from a qualified professional before making any investment decisions.
Hey, everybody. Thanks so much for joining us this week. I hope you enjoyed the episode. If you're finding it informative and useful, make sure to like, subscribe, share with a friend so that we can keep getting the information out there to Ontario landlords. And keep on joining us. We'll see you next time.